In terms of what percentage of your money you put into stocks versus bonds, well, that comes down to your asset allocation. Most people will consult with a financial advisor on this, but there's a general rule of thumb that many follow called the rule of 120. What this recommends doing is taking 120 and then subtracting your age, and this would be the percentage you would want to have allocated into stocks, with the rest going into bonds. So for example, if you were 20 years old, you would take 120 minus 20, and that would give you 100, or a suggested 100% allocation into stocks. But by the time you reach age 30, if you take 120 minus 30, that would give you 90% recommended allocation into stocks and 10% recommended allocation into bonds. As you get older, say age 50, that would then be a recommended allocation of 70% into stocks and 30% into bonds. Now, as a lower risk investment, overall returns from bonds are lower than the historical returns of the stock market. But when the stock market inevitably enters a bear market, the downside associated with bonds is not as severe as with stocks. Simply put, your portfolio would drop a lot less if you had a 50-50 mix of stocks and investment grade bonds, which we'll talk about that shortly, compared to owning 100% allocation into stocks.